So welcome back. Now, if you have issues with identifying drawn liquidity, it's because you don't understand the interaction between ERL and IRL. Okay, so what's the interaction? This is external range liquidity, this is internal range liquidity. Now, what I mean by external range liquidity is that the market will always do this, do this, do this, and do this. Why is it moving that way? Okay, the retail idea behind this is that okay, this is a higher high and this is a higher low, a higher high, a higher low. That's what they're going to tell you, right? But the smart money concept logic or the ICT logic behind this is that this is a buy side liquidity and that's an ERL. Okay, and whenever price takes it out, price will have to return to an IRL. An IRL consists of either a VG, order block, or an internal sell side liquidity between this range. So let me show you the range I'm talking about. Between this range, this high and this low. If there's a sell side liquidity in any form here, that's an IRL. If there's an FVG, that's an IRL. If there's an order block inside, that's an IRL. Now, this high, this low and these highs are like the boundaries, and I call them dealing range. ICT calls them dealing range. So dealing range, that's a previous video I did on this channel. So this dealing range between this low and this high is like the boundaries where you can trade. So now if you took out an ARL, price is going to return inside this range. So what should you do in such case? How can you make use of this information? Now a lot of times price doesn't just retrace. Don't I know some of you will be like, but yeah, price doesn't retrace sometimes. Now sometimes you might get something like this whereby price keeps going higher even after running a high, just like what USD card is doing right now. Okay, price might just keep going higher and higher even after taking an external range liquidity. Now you ask me, but then how are we going to like know it's going to go keep going higher or it's going to trade back inside the range? So now this is it. Before you ever try to start trading back into the range to seek IRL, there must be a market structure shift or a shock on the lower time frame. So if this is a daily time frame, somewhere around here there's supposed to be something like this. Okay, there's going to be something like this, a proper change of character, not this. Okay, not something like this, please. I'm not talking about that. I'm talking about something like this. There must be a high taken out and a low taken out. A high taken out and a low taken out. This must happen around this area. Okay, it must be seen happening around here. Now that's a confirmation that we want to trade back into the IRL. Okay, so that is a very useful information, and when you use it, you'll be able to know your draw on liquidity for every single time you're trading. So what are the things you need to pay attention to get your draw on liquidity? See it here. Let's start with dealing range. The first, identify your dealing range, and secondly, identify your IRL and chalk, and all of these things are comparisons. I think you need to know. So okay, dealing range. First of all, let's use another clean example. We come and we see price like this. Where is our dealing range? In this case, we just took out ERL, which is external range liquidity. And this time, what is our dealing range? This dealing range is past. So let me show you what I mean by this dealing range is past. This one is past because we broke through the ERL. It's gone. We are in a new dealing range, but the high has not been concluded at this point. We can't call here as a high. It has not been concluded. Now, in this particular case, we can't start trading lower into an IRL. It won't work. It won't just work. So what do? Rather, we keep our cool, and if there is a higher liquidity pool above, something like maybe there's a higher liquidity pool on that time frame above, it could be previous week high, previous day high, anything, old high that is up here, then it means price is trying to push there. So you might use your entry model that will show you, that would trade you higher. But we're not going to talk about entry models right now. We're just talking about drawn liquidity. So if price has not given that lower time frame chalk around this high, your draw is still higher. It means you're still going to push higher. But if price gives you that chalk, we know that okay, it's time to trade to IRL. internal range liquidity. Okay, and that's how you start shorting. Now on your way to shorting, see, you might have internal range liquidities like FEG as close as this point. Trust me, when price is getting into them, you don't want to fight the tide. You don't want to start looking for sales while it's there. You want it to either fail before you can start trading to the next IRL. This one fails, you trade to the next. You don't try to predict if it will hold or fail. Some of you price get into here, you want to start buying. No, you don't do that. Okay, so you want to watch it. You can sell towards it. If it gets into there, you chill. If it's failing, you can sell towards this. If it's failing, you can sell towards this. And that's how you follow these higher time frame structures. So now let's look at chart example to understand IRL to ERL, and this is going to change everything for you when it comes to what looking for your draw on liquidity, your daily buyers, and the rest of them. Okay, so now let's talk about it on chart. So now this is my daily chart. Where is our dealing range? So now let's look at our dealing range from here. Our daily range is the most recent high and low that has been formed on the chart. I like using red lines for my dealing range, and also know every time frame has its dealing range. Okay, every time frame has what its dealing range. So if I'm on the daily, this is my dealing range. And how did I confirm that this is my dealing range? First, this low led to the break of a previous high, as you can see. So this we can call that this is an ERL that price has taken out. External range liquidity, can call it buy side, can call it whatever, but it's an external range liquidity. Okay, so that's the classification of buy side liquidities, and very clear eyes. I see like this. So this is this low, and this high becomes a new. So what qualifies this low to be the daily range low is that it pushed price. The price broke an external range liquidity. What qualifies this high to become a dealing range high is that on the 4 hours it led to a choke. So now let's look at the 4-hour time frame. So this is the choke going on right here. So we had this, we had this, and we had this. Do you see a big ass choke? So look at it. We had that, we took out this, and we took out this. So when this has not happened, trust me, this was not qualified to be a daily range, a daily dealing range. A daily dealing range is not going to be qualified, but because it has happened, it's qualified. So take a look at it right now, back in the daily. Let's look at it. That's why that's the criteria to have this to be a daily dealing range high. Okay, so now as that has been confirmed, it's now clear that we're going to be trading lower. So look at your left, look at this point. What internal range liquidities are there waiting? We have order block here, we have a mitigated fair value gap. Now what does this teach you? This teaches you that this fair value gap will solely be covered. When we have a fair value gap that price has entered before, a return to that zone will most likely cover it. So I know there is nothing significant going to happen here. We are most likely going to come to this low. Most likely. We can't predict the market, right? But most likely. Now, if this other block fails, we are headed for the next internal range liquidity, which is this sell side. Like I told you, every other sell side in between this range is what internal range liquidity, except this external, because it's the boundary, it's the low of the dealing range. It's also an ERL because it's a dealing range. If price takes it out, we consider it as an ERL being taken out, right? So that's exactly how you get your draw. So now you're on the daily. What is now your draw on the daily? You know your draw is lower, which is this point. So what do you expect the market to do? Now, can you predict what the next daily candle will be? I don't recommend that because I don't do that. You don't predict. Right now, price is sitting in one of these IRLs already, an order block to me. How do I mark my order blocks? I mark my order blocks as the smallest candle before the explosion to the upside. So we are in one. Do we know if it's going to fail? We don't know. Do we know if it's going to hold? We don't know. Okay, so how would you now be able to know your bias in such a tight corner? The 4-hour time frame is going to save you a lot. Okay, the 4-hour time frame is going to save you a lot. when you don't know where to move from the daily. To me, the daily for now is uncertain. If this was not an order block, definitely we are coming lower. But as long as it's an order block, it's uncertain. It will start building candles higher to take out this ERL, or it can start forming candles every day to take out this and this. So how do we know where to go from here? The 4 hours will help us. So now let's look at the 4 hours. So like we said, we have been able to identify what daily dealing range. For you to trade the 4 hours and know what price do, you must understand what the 4 hour dealing range. The 4 hour dealing range is the most recent high and low. So we have it here. I like making my 4 hour dealing ranges green. We have it here, and we have this here. Okay, this is my 4 hour dealing range. So it means it's in this range. I would know what price is doing. Now, based how was this qualified to be? Though this is a downtrend now. So how was this qualified to be a dealing range high? Because it broke previous low. Remember, this is a downtrend. It's kind of inverted from what I told you about how the highs and lows were qualified on the daily chart. So this is a 4 hour chart. Why is this qualified to be a dealing range high? It broke previous low. Why is this qualified to be a dealing range low? Because on the 15th it led to a chalk. Now let's look at it. See where the chalk happened? So this has been a downtrend market for a while, and we had this and we had this. So we had this and we had this. And you see the chalk, this low go around, this high go around. So that's an example of a chalk. So no doubt, where are we headed to? We are headed what? Into an internal range liquidity on this range. So now we have known that we are headed somewhere. Now, where precisely are we headed is now our draw for the day. Like I said, if the daily time frame does not give you a clear draw, the 4 hours will tell you an intraday draw. So this is our next draw. These two areas, in between these two areas. Now, why this? Like I said, the smallest candle before any significant drop is an order block to me. Then we have the two origin order blocks. These two areas are a draw to me, and I like using horizontal ray to mark them so I can get the price. Now, if this is a draw to me, fine, it makes sense. Why did I choose this? Why didn't I choose this FVG? The same principle. What's the principle? We have this FVG filled before, so the next return is price to cover it. That makes here more probable to come. So what do I see in gold? I see an upward movement. That's what I'm gonna trade. So my entry model and my kill zone is a different thing entirely. I don't want to mix it in this video, but I'm telling you the next areas you should trade. To learn entry models and the rest, you learn it in my entry video. Like as you can see, if you don't talk about entry models, you see price reacting from an order block here, and you see on the 1 hour with the right confirmations, this would lead you higher. Okay, so but I can't trade this entry right now because the midnight hasn't been run. So all of those is topic for another time, which is this midnight hasn't been run. So I don't want to go deep into that because that's not what we're talking about here. So that's why I do not engage in these gold buys. But if I see price go below this inside this order block, then I can look for confirmation and we can go higher. So do you see the example of this ERL taking out, now IRL taking out? Now yesterday, why wasn't the same bias? It was not the same bias yesterday because when we took at ERL, there was no 15 minutes chalk happening around here. When I mean chalk, I mean this. Please don't get me wrong. I mean this. When I mean chalk, change of character. There was no change of character with 15 happening here, so there was no low. So we can't trade to IRL. So price is most likely gonna drop, keep dropping. Like I said, keep dropping until when it has shown you that okay, this is an established 4-hour low because of 15 minutes chalk. We know we can now trade to IRL. So the same thing happens in all the time frames. The same thing happens in all the time frames, between even the weekly and the daily. Between the weekly and the daily, the same thing happens. So now if you look at the weekly, the same thing. Now, is this a weekly IRL? Sorry, is this a weekly dealing range? That's the question. So I'm going to clear everything. Let's see. Is this a weekly dealing range between this and this? So this is high, this is a high, this a low basically. And why did I choose this low and this high? Because this low led to the break of this previous one. So will I call this a weekly dealing range? I don't know. How would know is, first of all, this low is qualified to be a dealing range low because it broke this high here. So yes, it makes sense, right? But then, is this high qualified to be a weekly descent? So how do you know? You must wait to see if the daily has broken structure, has done a chalk. Has the daily done a chalk yet? No, the daily has not done a chalk yet. Okay, so if you are following the daily ranges, you will notice that this is the nature of how the daily structures are. So look at it. We had this, and then we took it out here. Now this low is a very serious low. Until price breaks that low, that's when we're gonna have that as a weekly delivery. If price breaks here, immediately price breaks this low, then see this high is gonna qualify to be called weekly dealing range high. Like I do mark my weekly dealing range high black. I do mark it black. So I'll just do it here so I can distinguish. Okay, so until this happens, it runs here. Here is not a weekly dealing, but this low is for the weekly, but this high is not yet qualified. Do you understand? When this high is qualified, then that's when here is broken. So it means we can now trade. Immediately that happens, what does it mean? It means on the weekly we cannot trade into internal ranges on the weekly, because take a look at it. If you want to draw these weekly structures, you can draw it from here, this low to this high. You get? So if price breaks here, what are we going to do? It means price is now ready to start trading into this internal range liquidity here on the weekly. So it's going to be a down ride for a long time. But if it doesn't happen, it means this is just a mere retracement. Later price will start going up, meaning it's just a mere retracement. Meaning on the daily is only when you're going to have the big retracement to the IRL. I hope you understand. I don't want to make this video complicated. I don't want to add too much things to it, but it's simple. The basics are the basics. We make a high, we make a higher high. That's what retail logic calls higher low uptrend. But in ICT, this is ERL taking out, price coming back is into IRL. And now there'll be times, this is a recap, there'll be times when price refuses to pull back down. That's because around these areas there was no chalk on the lower time frame. Remember, what gives you a confirmation the lower time frame? From if this is the weekly chart, what gives you that confirmation is the daily chart chalk. If this is a daily chart, what gives you that confirmation here is the 4-hour chalk. If this is a 4-hour chart, what gives you this confirmation here is the 15 minutes chalk. That's how it happens. But if it doesn't give you, it means price is still ready to stretch higher to an existing liquidity pool above. You just have to look out for it, and your entry model will still take you even higher. See you guys in the next video. I hope you found this very, very helpful.